1 minute ago, headlines exploded. Social media started shouting. Finance Twitter went crazy, and suddenly everyone was saying the same thing. Warren Buffett is exiting U.S. positions linked to Canada trade. But here's the truth most people won't tell you. Warren Buffett doesn't move like the news cycle. He doesn't react in minutes, and he definitely doesn't panic. So what's really going on here? Stay with me, because by the end of this video, you'll understand what Buffett-style exits actually mean, why most investors misunderstand these headlines, and how smart money really reacts when trade narratives change. Let's slow this down. When people hear Buffett exits, they imagine something dramatic: overnight decisions, secret phone calls, urgent sell orders. That's not how Buffett operates. Buffett plays a different game, a quiet game, a patient game. And understanding that difference is exactly why most people lose money, while a few build wealth over decades. The phrase "exits all U.S. positions linked to Canada trade" sounds powerful. But notice something important. It doesn't say all U.S. positions, all investments, or a full market exit. It says linked to Canada trade. That's a very specific narrative. And when narratives become loud, Buffett usually does the opposite of what headlines suggest. Warren Buffett doesn't invest in countries. He doesn't invest in trade deals. He invests in businesses. Businesses with strong cash flow, pricing power, durable advantages, and management he trusts. If a company depends heavily on one trade relationship, Buffett asks a simple question: is this business still strong without perfect conditions? If the answer is no, then the problem isn't Canada. The problem is fragility. Retail investors hear trade tension and they panic. They sell everything. They jump to cash. They chase headlines. Buffett, he zooms out. He asks, is demand permanent or temporary? Can this company adjust pricing? Does it own its customer relationship? If a business cannot survive mild disruption, it was never a great business to begin with. This is crucial. When Buffett exits a position, it's rarely because he's scared. It's because the business changed, the valuation no longer makes sense, or the original thesis broke. Not because the news told him to. That's discipline, not panic. Trade relationships matter only when they permanently damage earning power, reduce long-term margins, or destroy competitive advantage. Temporary trade noise doesn't scare Buffett, but structural dependence does. If a company relies too much on one export route, one political agreement, or one regulatory environment, then Buffett starts questioning durability. And durability is everything in his world. Buffett is famous for one rule. The first rule of investing is don't lose money. But people forget the second part. The second rule is never forget the first. That means avoid fragile businesses, avoid complexity you don't understand, avoid situations that require perfection. Trade-dependent businesses often require perfection, and Buffett doesn't bet on perfection. While headlines scream exit, smart money quietly reallocates, not out of fear, but out of logic. They move toward domestic demand, pricing power, simple business models, predictable cash flows, boring businesses, unsexy businesses, resilient businesses. That's where Buffett has always lived. Look back at history. Whenever global narratives get loud, trade wars, political tension, economic fear, Buffett does one thing consistently. He simplifies. He reduces exposure to complexity and increases exposure to clarity. That's not bearish, that's intelligent. If you're watching this and thinking, should I sell everything, you're asking the wrong question. The better question is, do I own businesses that survive uncertainty? If the answer is yes, you don't need to panic. If the answer is no, then the headline isn't the problem. Your portfolio is. Every so-called exit sends a message, not markets are ending, but quality matters more than ever. When noise rises, clarity becomes valuable. When fear spreads, patience becomes profitable. Warren Buffett didn't build wealth by reacting fast, he built it by thinking clearly. And while headlines chase attention, quiet discipline keeps winning. If you want to invest like Buffett, stop asking what he sold today. Start asking why he bought it in the first place. Because that mindset, not the headline, is the real edge. If this video helped you think more clearly, stay patient, stay rational, and remember, the Buffett way is never loud, but it always lasts.